So take it away.
Okay. Good evening, everybody. I'm Allie Serba. I'm the Marketing Director with Sterling Financial Management. Thank you so much for joining us tonight for our State of the Markets webinar. I would like to introduce you to Dave Neterer, our President and owner of Sterling Financial Management. He started the company over 10 years ago and has been a private wealth manager for the last 28 years. So go ahead, Dave, and take it away for us tonight, please.
Thank you. And thank you, everyone, for joining us this evening, taking some time out to kind of hear what the expectation is for the year. Thankfully, an economist and weather reporters are all in the same boat. We tend not to lose our jobs, even when we're entirely wrong. So that's kind of an indication of where the year might go. But we'll kind of give you what we think is our best guess for the year here. So if anybody else is trying to join us here, we'll be letting them in as we go along. But so first off, let me introduce our newest financial advisors. We have Forrest Miles. That's with us here this evening. So Forrest joined us in early December. So Forrest is joining us from PNC Bank here recently. He's got well over 30 years of experience as well. And so happy to have Forrest join us. So he's going to be servicing his clients from down in the Haymarket, Virginia area. So welcome, Forrest. Happy to have you on board. All right, so we also have, thank you. Yep. Zoom meetings, you never can tell when somebody's going to speak, so we tend to talk over each other. It's the one downside of a Zoom. We can sit home and watch in our pajamas, but unfortunately, it's not very conducive to reading people's expressions and all that stuff. But so we also have joining us Bruce Neterer. So I'm happy to say it's the same last name as him and bears some resemblance, but my son Bruce just graduated from Cal U of Pennsylvania with a degree in economics. And so he joined us also here in December, worked real hard and graduated in 3.5 years. And so happy to have Bruce joining us here. So he'll be starting out in our operations and kind of our client service role and getting licensed. So he's got one more test, the Series 66, and then he'll be fully licensed. So also happy to have Kelly here with us as well. She's been with us almost 10 years, 11 years probably now. So 2011, Kelly's come on board. So fabulous staff and happy to have the group of folks that we've tried to assemble to help you folks, our clients. So go ahead and jump right into the presentation here. And there we go. All right, so we have to have a bunch of fine print. So as you can imagine, so we've got all of our proper disclosures on here. Biggest things, as most of us know, investments go up and down. We're trying to give you our best guess on the direction of the market. Of course, a lot of things factor into that. And so take it for what it is, trying to help kind of guide and find a direction here. As Allie had mentioned, and so she's done a fabulous job here in putting all this stuff together. We would appreciate it if you'd pop out to our Facebook page or our website. More information is on there. We'll be sending the slides and a survey around, so we'd appreciate some input from you folks on maybe some topics you'd like to hear, other ways. We're constantly trying to evaluate whether we should do this in person. Or whether folks like it better via Zoom. And so we're going to do a combination of both. So here's some of our upcoming seminars that we're planning on having. So tax planning, we're going to do that in February. That's going to be in person. So if you'd like to attend that, It's going to be at the Frederick News Post. It's on Ballinger Creek. So we'll do a Zoom and in-person thing for that. We have a shred event that's happening, so you can drop your stuff off here if you'd like to do a shred. Estate planning, which is also going to be in person in Thursday, March 23rd, and then college bound Social Security. And then we're also going to have another Medicare and probably another estate planning. So trying to improve our educational communication and things around topics that clients are interested in. So those are some of our upcoming seminars that we've got. And by all means, we'd love to have some questions along the way. So don't feel like you're going to be interrupting. Everybody's on mute right now. I believe there should be a bar across the bottom of your Zoom down there to unmute yourselves. So feel free to do that throughout the seminar. I think if you hit the space bar on your computer, I think that temporarily unmutes you. So if you have some questions like that, you can do that. Kelly's going to kind of be watching the chat feature. So if you guys have some questions in that way as well, we can send it through in that way too. So we're going to look at kind of how stocks performed in 22. So that's in the rearview mirror, kind of look at some of the events that happened, where we sit today, and kind of look at some of the forecasts for 2023 and kind of talk about what we think some of our expectations are for the year. All right, so I think the first thing that we can look at here is that all of the big major financial firms did a horrible job in predicting what 2022 was going to look like. So we started the year at 4,778. And as you can imagine, a lot of them kind of expected somewhat of a, kind of a flat year. However, down 19% for the year. So we finished at 3,839. That's as how we measure the S&P 500. So the S&P 500 is an index. So it's just a way that we can kind of measure the movement of those 500 stocks that fall on that index. Now, kind of an interesting perspective is, even though there's 500 stocks on that index, it's called a market cap weighted index. So market capitalization weighted just means that the biggest stock on that index, which at different times has been Apple, and but it's so Apple represented and technology represented pretty close to about 30% of the index. So technology is a big driver of kind of the direction of that that overall index. So it's called the S&P 500 index. Now I'm trying to remember in my career a year when we've had pretty much every index that we could measure be down. So I know this is very small. So this is the December 30th year-end kind of other indexes. So we talked about the S&P 500 being down 19%. Diversification. What if we had small cap stocks? That's measured by S&P 500 or S&P, the Russell 2000 growth. How about Russell 2000 value? How did that do? So that's small cap stocks. Mid cap stocks, international stocks. So 2022 was a very, very difficult year for financial advisors. Diversification didn't work. So about the thing that was positive, and I'm colorblind, so I don't see red and green very well, but I do see red and black. As you can see, there's only two things on 40 different indices here that were positive for the year. So if you held commodities, if you held energy, those were kind of two areas that had some positive results. But so then typically we would say, okay, stock market's having a bad year, so bonds should be having, a better year. Things are bad in the stock market, bonds are usually good. Again, we look at this 1 year return. and we can see that there's only about 2 or 3 things on this index that even, have some positive results. So our stock and bond ratio last year, I heard a statistic that said that the stock and bond market had not been that bad since the late 1800s. And I didn't even realize that we were taking measurements back in the 1800s. But again, I think fair to say it was kind of a difficult year overall. So if we look at some of the events that happened, I mean, it was basically almost a nearly year-long decline in stocks. You can see we had a couple of little fake bounces there in July, kind of the August timeframe, but pretty much, it was in a decline for most of the year. And even as it was going up, we weren't really kind of building a nice base like we would typically see in that case. And one of the things we look at from a charting perspective is just about the time we get a nice bounce, it would go back down. It would go through its previous low, which we don't like to see. So it would break that previous low and then continue trending on down. So you can see from some of the data points, in January, we got a print of a really high inflationary environment. So I think that kind of started the year off on a really bad note. We saw inflation get above that 7% level. And so, I think that inflationary thing was a big driver of last year. And so one of the ways that we combat inflation is the Federal Reserve comes out and they raise interest rates trying to drive some of the loose monetary policy, drive and dry up a lot of the dollars that are floating around in the economy. So the Federal Reserve reacted to that and started a march of higher and higher interest rates. So also, I think that the Ukraine war, I think, was a big part of kind of a scare early on, and Russia continuing to kind of a nuclear opportunity. So, as the year ground down and I think Ukraine started to do a little better in that war, I think that wore off a little bit. But, as you can see, also GDP, which is a measure of the growth of the economy, began to shrink a little bit. And so recessionary fears kind of came into, the market overall. And so finished kind of, pretty much almost on a low point towards the end of the year. It just kind of brings in the measure of the volatility that we saw last year. So initially we started the year, markets fell pretty close to 13%. We had a nice little rally. We thought we might be doing okay. We dropped 20% around June. We get a 17% rise off of that. We fall back down to 16.9, kind of hit the low point of the year. I think September 30th, just about the time everybody had their statements printed. So September 30th, I know, drove a lot of calls. What's happening? Where's the market going? I don't like what I'm seeing happen in my statements. So we got a lot of those calls in around October. We got a nice little bounce towards the end of the year. But again, volatility towards into the close of the year. So I also saw a statistic. I think there were 38 periods of volatility above 4 or 5%, which was, I think the last time we saw that was like in the early 70s or something like that. So just kind of highly unusual. Part of, I think, the volatility was also being driven by interest rates. Not sure how fast the Federal Reserve was going to be raising things. So I think if we do end up having a recession, this is probably one of the most well-publicized recessions that we've ever had. And usually about the time that somebody says we've got a guaranteed recession coming or some other type of an economic event, a lot of times it doesn't end up happening. But, from here, I think we're starting to see some trends in the right direction. And obviously, it's going to play itself out through the course of the year. But one of our other advisors, Ken, brought this to me today and said, look at where we've come from. So what you're looking at is a money market account. And a money market account is a liquid investment. So we can invest in it today. We can sell it tomorrow. So this is a money market account that only invests in US Treasuries. Well, January of 2022, you could have earned a whopping 0.01% in that money. So pennies on thousands and thousands of dollars, right? But if we look at that, just look at where we finished a year at 3.48% in buying US Treasury. So in 2022, we just had some very dramatic events happening throughout the course of the year. And I think a lot of things that may be kind of, taking our eye a little bit off of some of the other good things, but we just had a lot of events happening we hadn't seen in quite a long time. Okay, so revenue growth. So if we look at corporate earnings, so that's one of the things I think that is going to play out this year, and that's probably the biggest question that we have. So if we go back to the first quarter of 2020, right? So that was the start of COVID and kind of the start of the lockdown. So as you can see there, the corporate earnings just were horrible through the second quarter of 2020, down 31%. We started to see some improvement, right? So the economy kind of started to begin to loosen up. Government passed some legislation, started helping with some fiscal stimulus, unemployment and all of that stuff started to hit. People had money in their pocket, they started to spend, and in 2021, businesses, but also the consumer, the individual, had money to spend, and so we saw that happening, and that rebound happening in corporate earnings. So, reversal on the opposite side of that in 2021. So then our 22 earnings, comparing that to previous years, of course, anytime you hit a new high in profits, if we're looking backwards and we're trying to do better, right, it makes it more difficult to kind of get above those previous years. So, economic growth in 2022. So we saw a little bit of contraction but we saw a pickup. So now we're talking about 2022's numbers. So GDP was a little bit negative starting the year, improved the second quarter, improved into the third quarter, and then the fourth quarter, I think that number today was like 2.3% came out. What's kind of interesting is a lot of times in a recession, we see job losses kind of leading that. And so far, our labor market really has not reacted to that at all. So, it's kind of interesting in that, our unemployment rate and the amount of jobs that are available in general is still pretty plentiful. Inflation. But we're starting to see that peak. We have another slide inside of that. Consumer sentiment, which a lot of times doesn't, drive the market a whole lot, but we're starting to see that. I think one of the interesting things that has to play itself out is higher interest rates obviously have an impact on housing. And so, we've definitely seen the cost of, we've actually seen rents go up, and the number of new homes that are being built kind of tail off a little bit. We talked to a realtor today that said that in a typical market, they would have 1,200 homes in Franklin County, Pennsylvania, that are in inventory. Today, there's 200. So even though we're starting to see higher interest rates, there's almost no inventory. And there's kind of a big discussion around, well, who's going to sell their house if they've got a 2.5% mortgage rate and move and then now get a 6.5, and I'm going to double my cost. So, it'd be interesting to see how that housing market plays out. But I think we've seen a peak in rents rising, and I think that's going to begin to tail off a little bit. And probably towards the fourth quarter of this year, we'll probably begin to see interest rates probably being brought back down. And a lot of that just has to do with, I mean, the government at this point has no incentive to try and keep the interest rates high. Why? Because it makes the cost of running the government more expensive, because the government has $31 trillion in debt at this point. So I would imagine that the Federal Reserve is probably going to be the federal government's probably going to try and bring those numbers down, and keep them on the lower end to help kind of keep those costs down. So we have a question here somebody sent through. Can you break down consumer sentiment? We had some, and to be honest with you, I don't know that I've ever really delved into that number all that much, in that I think it's just a survey that's out there, and it's just trying to measure how the consumer feels about the direction of the economy. But how about if we get better kind of an explanation for that for you. So unless somebody else has something else to add to that, but good question.
Can I say something on the consumer
Sure.
sentiment?
Absolutely. Sure.
One of the things, and I listened to another conference call today, and they were talking about that. People are concerned with the rising costs, of course, of energy and food in particular. So the sentiment right now is people are worried that it's going to continue. I know of people today, I saw information, people were complaining about their electric bills had gone from $300 last month to $600 this month. The weather hasn't been that much worse. It's just that companies are raising prices. With the consumer sentiment on the actual consumption, you hear and read everywhere about how much food costs are going up. And I actually went to the grocery store early this afternoon to pick up some things, and I saw the price of eggs, and I just went, "Oh my gosh, they're incredible. I need to lower my cholesterol, and this is going to help me do it, because I'm not going to be eating as many eggs." But the economic growth is beginning to creep back in, and more, as David touched on earlier, with the employment numbers, job openings have come down from their highs. And so more and more people are becoming employed, and that will give them more disposable income. The other side of that are people right now are concerned. If you look at their amount of debt that they're taking on to keep the same standards of living, that debt is going higher and higher. And of course, people will be concerned about that when they get if they have variable rate credit cards, their rates are going up, and it's going to cost them more to service that debt. So I think that a lot of the consumer sentiment is there, that it's on edge right now. And I see that question, I missed the question, it disappeared, about the base level. I don't know what the base level is. I've never heard anyone really describe what the base level is. It's 0 to 100 level. I think anything, I really don't want to speculate, because I really don't know.
Yeah.
But I think going forward, we will see the economy grow. It's not going to grow as fast as it has over the last decade. The actual Federal Reserve numbers, the growth on that, they have cut back quite a bit. And I think that we'll see next week, after the Fed has their meetings, we'll see what they're thinking. Although I will tell you that the market is not as thinking about the economy and the rates and things as harshly as the Fed is. And typically the market is more accurate than the Federal Reserve. So, that to me gives us a lot of hope about what will happen in this market and what's to come over the next 2 or 3 quarters.
Yeah, and I think even to add to that, I think the bond market, if anything, is probably a faster indication of what the future holds, and we're starting to see interest rates decline a little bit. So kind of gives us an idea that we've hit a peak in that so and an indication probably the Federal Reserve probably would back off sooner than expected. So here's kind of a dashboard of some of the economic and financial indicators. So this is November of 2020. And so you look at, there was the monetary policy, economic outlook was still favorable, yield curve. There's our consumer sentiment figure, which James will get a better clarification for you on that. Housing, mortgages, right? I think we'd hit almost an all-time low there. So a lot of those indicators were very positive, very low inflationary rate, didn't have anything there. About the two things, geopolitical and equity market valuation, I don't know, this was going into the November election. So, we'd expect geopolitical, but, the equity probably, if anything, market valuation, we'll kind of see that on one of our slides coming up here. Then we take that to November of 21. And of course, as you can expect, when the government dumps trillions of dollars into the system, there was nowhere for things to go except for up. So the economy just took that and just roared back to life. And so here we are in 2022. And in general, so we're starting to see a lot of those economic indicators slide a little bit. Leading economic indicators declining a little bit. Inflation's peak, but coming back down. We're starting to see a few signs of that. So it's I almost right now we're kind of on a standing on a teeter-totter where depending on where events go, we could slip back a little bit, or depending on where rates or where things go, we could rebound from here and have a halfway decent overall year. This just came out today. This is coming from LPL Research. So this is just looking at last year and some of the categories that can contribute to growth, and the slowdown in mid-year, but then a pickup and kind of flattening out here in the fourth quarter of 2022. So again, there's a lot of positive things that we feel like that's happening. We've seen a lot of earnings reports come out, pretty positive, for barring Southwest. I don't know if it fly around December, but as expected, Southwest took a really big hit there with their corporate earnings, but like JetBlue was pretty good, and United was pretty good. So we're seeing that it really, I think this year is going to be what they call a stock pickers market, which means that managers are going to have to really be careful about what they own in the portfolios. And you may see one segment of the market or sector doing really well when some of the other things may not. So we're really going to see, I think, that play out over the course of the year. Okay, so leading economic indicators so you can kind of see a chart of that here. As you can imagine, 2000, 2003, a recessionary environment, a little peaking there to growth, and then 08, pretty severe decline, not doing too bad through 18, 19, and of course 2020 with COVID hitting. And then, we saw the big spike in 21 with a slowdown into 2022. So some headwinds that we really were, inflation and rising yields. So I think the Federal Reserve has got to see that inflationary number coming down. What's kind of interesting is the way the government measures inflation. A large part of that is real estate, rents, and the cost of housing. So of course, if you have rising yields and the cost of housing going up and rent increases going through the roof, that's going to impact inflation a good bit. I listened to an economist, EMBC or strategist this morning. He feels like in May of this year, we're going to get a negative inflationary print just because housing is going to be impacted so severely with those interest rates. Of course, Fed policy, there's an old adage out there, don't fight the Fed. So, as the Fed is pretty persistent on driving down that inflationary number, really, I expect probably 2 tightenings this year, at least 2 25s, another 25% increase, and probably pushing through that 5% level. But then I would really expect the Federal Reserve to probably back down. But again, they've got to see that kind of play out in the markets. We still have Ukraine and Russia out there. China kind of saber rattling towards Taiwan was another thing that was in the news at different points. But so far it kind of seems to be the Ukraine Russia stuff. I was going to say kind of thankfully it's contained to their area, but right, it's just a horrible situation. But of course we're concerned about corporate earnings, but so far we haven't seen much there. Although there's some research we've looked at that they're kind of concerned about what may end up happening there in earnings. Tailwinds, of course, we're starting to see moderation of inflation. A more dovish Fed, so they've kind of backed down on some of their language. U.S. So we saw that peak and then really begin to trail off. So what that does is it helps us here at home. It makes foreigners, it makes the cost of our goods less overseas. And so, that's good for us. Rate cycle we think is kind of peaked or begun to peak, but very soon maybe coming down. And then this may be also kind of a sleeper, but China went from 100% lockdown to almost being like wide open in the matter of a week. So, China is now reconnected in Davos. I think Biden had met with Xi over there, and I think they had kind of reestablished some direction for the year. And so, that may also help us as well. So we talked about the S&P 500 and kind of the valuation. So this is what we call the price to earnings ratio. So what am I paying for a unit of profit, price to earnings? Now, if my earnings drop and I have the same stock level, my PE is going to go up. So sometimes, we could see a drop in earnings that would cause my PE ratio to go up. But if my earnings drop and my stock price drops, we would see that PE ratio stay in line. Or if my profits stay at the same level, but my stock value drops, we would see that price, the PE ratio, to drop. And so that's really what we saw through the end of the year. You can kind of see there's a 25-year average. And so PEs towards the end of the year, we're hitting around 15% or 15 times earnings. And so in around a level to where I think a lot of managers were beginning to find stocks be at an attractive level again. And so back in line with kind of a long-term average. Okay, so we kind of talked about some market things, some things that might have impacted it. And so we'll get into kind of some forecasts here. We talked about some of the fiscal stimulus, And here in the U.S., we are almost about 70% of GDP and growth is coming from consumer spending. So we're a very consumer-oriented and driven kind of a market. And so the health of the consumer is really, really important. So government putting dollars in people's pockets and or maybe possibly staying at home, not being as out and about as we were there for a period of time. Maybe weren't spending quite as much. So really, if anything, we saw that savings rate really go up. And the right-hand kind of chart there shows us the excess savings. Now, here recently, we've started to hear kind of an unwinding of that. So we're starting to hear some news coming through about credit card debt beginning to increase a little bit. And so, but in general, the health of the consumer right now is pretty good. And there's still some pretty good excess reserves out there. This is part of quarterly earnings per share. So kind of maybe a little bit of a slowdown through the first quarter of 23, but that picking back up into the fourth quarter of this year. So, you know, it is very difficult to kind of forecast those the earnings of a corporation, but of course, you know, they're also very, very disciplined. Large corporations are very disciplined, you know, with their profit levels and how they run their businesses. So in a lot of cases, you know, they're so even the middle of last year, we saw, you know, Laura said you know, corporations really started to pay attention to and or raise prices, right? So that, you know, the cost of eggs and cost of everything. So packaging tends to get smaller. So I can't even imagine if I held up a candy bar that I bought in the 1980s and the candy bar I'm buying today. Normally it's the same size package. It's just everything inside of it has gotten smaller and smaller, right? So that's that inflationary environment that's coming through. So I think the discipline of corporations, and I think if anything that gives me comfort in investing in what we're doing is after 30 some odd years, you know, we can still in this way. We tend to go through periods of volatility, you know, concerns, what about this, what about that? But really the discipline of corporations over time, they find ways to become more profitable and, you know, and get back. So this chart here just kind of gives us a gauge of where people think interest rates are going to end up. And so kind of the anticipated interest rate peak is somewhere between 4.75 and 5. So as you can see there, not very many people think we're going to get to 5.5 or 6. So the expectation is for the Federal Reserve to kind of begin to stop their raising of interest rates in that tightening cycle. So I think we're almost kind of through that. This gives you a kind of a general idea of real GDP and unemployment. You know, as we said, it's unemployment's up, but it's still nowhere near. I mean, past recessionary periods, unemployment has reached 6, 7, 8%, and we're just not seeing that. That there's still jobs out there, and we're also seeing wage increases as well. So kind of a good sign there for the consumer. This also just kind of looking at the pulse of the labor market there. So the ratio of job openings to job seekers. So we're also looking at total non-farm people that are quitting their jobs, and layoffs seasonally adjusted there. So in general, just the health of the labor market still pretty good. So forecast for 2023. So we talked about the so in general, kind of the general consensus is in around 3,800 for the market for the year. And based on where we closed today at 4,060, kind of the general consensus right now is for a flat year. So we're at we closed up 44 points today. So in general, the forecast is for probably a down year. But you know, first trading, I think we've hit January. I think we've had the best January since, you know, forget the time period they were looking at, but really in general, January has been pretty good so far. All right, so I thought I'd throw in here some of our, or if anybody, I don't know if anybody's chartist out there or likes to follow some charts, but one of the things that's kind of given us a little bit of a comfort. So I think this report, I think, was as of January 20th, but things that we're seeing is there's what we call a 200-day moving average. And that 200-day moving average, again, is just taking 200 points on a chart and averaging them together. So as you can see, the 200-day moving average, when the market declines, trend down to some point until we can begin to kind of break above that point. So you can see it there in December, but we finally were able to kind of break out above that. And again, the S&P 500, don't forget, has a lot of technology in that. So, you know, the technology market was one of the last kind of areas that had not confirmed that 200-day moving average. Sometimes it's called a golden cross. It's just where the markets again break out above that 200-day moving average. So we see that. So this is an updated chart of adding another 5 more days, and you can kind of see again that breakout above that level. So from a charting standpoint, it's an encouraging sign from a technical perspective. So and I think one of did that update? Yeah. Okay. So the other thing that's on this slide is we've got on there the US dollar. So we can kind of see that trending down. We're also starting to see interest rates kind of begin to trend down a little bit, which, you know, those are the tailwinds that we've kind of been looking for. And also shows us the trend line in CPI and inflation. So we've also begun to kind of see that. So we're starting to see kind of some glimmers of some hope of what we think is might be a bottoming process here, and possibly you know, maybe improvement from here, at least in the direction of the investments that we have. All right, so one of the things we wanted to share with you folks is just, you know, sometimes we get caught up in the day-to-day gyrations of what's happening in our portfolio. Investment discipline, we kind of stick to a good investment process or good investment discipline and process of diversification. It tends to work out. So we're looking at going all the way back to 1977. And what we're looking at in this chart is if I'm holding both stocks and bonds in my portfolio, 60% of stocks and 40% in bonds. So you see the two different highlighted, the two different color that we have in there. What color is that? Anybody knows that? Blue. And then it looks like pink for the bonds. So you can see what contributed to performance. So you can see the stocks obviously have higher highs, and then you see the bonds in there usually don't contribute all that much to our performance, right? They should be more of the steady. So if we look at 1977, first year stock and bonds on our chart, stocks were down, bonds were up. And so we see that again happening in 1981, stocks were down, bonds were up. We go to 2000, same thing, stocks were down, bonds are up. We go to 2022, And of course, our bonds were down and our stocks were down. So again, we hadn't seen that type of volatility in both stocks and bonds late 1800s. We feel like we're really in a position where we can make some improvement from here. Again, if we're at a 5% level in bonds today, we really feel like there's, some the bad returns we've had are behind us, and we should see some improvement from there. So, because again, we don't think interest rates are going to go much higher. And now we're actually able to really make something, savings on the more conservative parts of our portfolio. Other trends that we kind of just wanted to share with you folks as well is for the longest period of time, was one of the best performing areas to be in. I mean, I think the QQQs, which is a measure really of the technology area sector of the market, I think QQQs at one point had like an 18% average annual return for like a 7-8 year period of time. We've now seen that really begin to rotate. So whenever we have high interest rates, the cost of capital really begins to hurt those companies that may rely on more lending sources. The value side of the business, which is a lot of banks, insurance companies, some of the staples, utilities. So the value side of kind of our investment sector, typically when we've looked at periods of volatility, value kind of comes into play as an area of kind of outperformance. So we can see that in the 2000 recession, in the 08, and we've really begun to see that here recently. And so we also feel like this is probably an area where we can take advantage of that within our portfolios and what we own, kind of getting back to more of the dividends, dividend paying types of investments that are a little more, little stable and more secure area. So one of our value managers last year was down 1 for the year when the S&P was down 19. So we're starting to see that kind of outperformance in those areas. And like I said, it's back to kind of being a stock picker's market. So something to pay attention to if you're still, 401ks, things along those lines. Take a look at where you're positioned inside of there. Or if you'd want us to help you take a look at it, we can do that as well. But right, so we just hope to be able to connect with all of you folks over the course of this year. Do that in person. Obviously, let us know if things are happening in your life that your financial situation. Key thing is to make sure your financial documents are up to date. We would highly encourage you to make sure as you have your family about where your important documents are, how to find them. If you don't have a will, make sure you have one. We'd encourage you to come to our estate planning thing that we have coming up in March. Have an attorney there that can help answer a lot of questions for you. But heaven forbid, we've had a lot of friends this year that have passed. It is something that you need to make sure your family is ready for. So make sure you know where those documents are. And then secondly, make sure your family knows where those documents are and make sure they're up to date. We're going to have consistent seminars throughout the course of time. Manage your investments to a personalized strategy. And of course, we're constantly reading. All we do is read the financial literature and watch the daily gyrations of the market. So we'll make sure we do our part in helping that. So the end of our presentation for tonight. So thank you guys for sitting through that. Do we have any other questions? Again, I think you can unmute yourself through the toolbar down at the bottom, or if you press your space bar. I think that'll take that off mute.
Dave, I did find some information on the consumer sentiment, if you want me to go over that.
Sure, absolutely.
I'll try to answer that question for James. So the consumer sentiment is measured by the CCI, which is the Consumer Confidence Index. I'm going to see if I can share my screen. Oh, Dave, you need to stop sharing yours.
Okay.
All right. All right, so says the consumer confidence indicator provides an indication of future developments of households' consumption and savings based upon answers regarding their expected financial situation, their sentiment about the general economic situation, unemployment, and capability of savings. An indicator above 100 signals a boost in consumers' confidence towards the future economic situation, as a consequence of which they are less prone to save and more inclined to spend money on major purchases in the next 12 months. Values below 100 indicate a pessimistic attitude towards future development in the economy, possibly resulting in a tendency to save more and consume less. And right now, consumer index, well, as of end of 2022, was about, what is 96 maybe, or 90, yeah, 96.8 or something like that. So it is, as far as this chart goes to the end of December, it is below 100. So hopefully that answers your question, James. A bit more insight into that.
I think our chart had that at 56, so we'll have to see where that
Oh, yeah. Oh,
number
Yeah,
reads, if that's the same CCI number.
okay.
There has to be some type of adjustment to that, but
Yeah.
yeah. And from what I said, what I had pulled up to, it just indicates economic growth in which consumers are spending money, and the higher the number, it indicates higher consumption. But
Right. Okay.
yeah, and so, yep. So good thought. So James' question was just kind of curious where the baseline is. So if there's if there'd been like, is it above baseline, below baseline, kind of
Yeah.
where we're at. So
So it looks like 100 is the baseline. So. Anybody else have any questions? Don't be shy. There are no such thing as dumb questions.
we got to put the new advisor on the spot, Mr. Forrest Miles. So we got to have a good question.
Make him sweat today. See, this is the hard part about webinars. We can't get that interaction, right?
Folks, well, we appreciate everyone attending, and as we had mentioned, Allie will be sending our survey around. We would appreciate we would appreciate filling that out. Another good question for us. So, what did you spend for the eggs today? You bought?
I didn't buy any. No, I didn't buy any, but they were pretty expensive, by twice the price of what they were last year.
He wants to know medium, extra large, or large.
That's it. That's it.
Yeah.
And
I think
I want
good.
organic egg. So I would think an egg produced by a chicken would all be organic. But so I think you need James. I think you need to add in there free range. Is it free range chickens? We had chickens growing up, And the ones that weren't in the cage and out ranging around, boy, they were not very good looking chickens. So they always seem to be some of the skinniest ones that are out there. So I don't know if it turns into egg production or not, but I can tell you, I did buy some. It was $6.94 was what I paid for 18 freaking eggs. So
I saw someone posted on social media that Costco was having a sale on theirs. I think it was it might have been 18 eggs. It's either 18 or 24 for $7. Of course, they had a limit of, you can only buy 2. So
crazy. Then I thought of something else about eggs. Eggs are going to be the next kind of black market, kind of the black market order. So that's going to be the next black market coming in from somewhere. So all right. Well, thank you guys for sitting with us today, and so look forward to connecting with all of you in person. So have a good evening. Thank you.